Stuart, how hard is it to navigate a market where in some parts, and you stress the fundamentals, but in some parts, the fundamentals, the earnings, they don't matter?
It's a great point, Jonathan. I think, the last couple of weeks, we've seen a lot of these high short interest stocks, which I think would fall into the category that you're describing, really, really rally. And certainly that's been really difficult for active managers. So, if you talk to our credit strategists, I think, they're feeling reluctantly pretty good about things. To your point, there's just a massive amount of liquidity in the system. So, I think what that does is it makes it much harder to run a short book because the companies with the weaker fundamentals are not realizing those fundamentals the way they used to. And if you're short a stock right now, you're really running, serious risk to your portfolio to be in those stocks. So, without a doubt, the amount of liquidity that's in the system is impacting things, whether that's monetary or fiscal. And it's definitely, I think it's been much more difficult if you're a short investor or if you're outside of stocks that have really poor fundamentals, because those stocks, to your point, are just not realizing the price performance that might be consistent with those fundamentals. To the upside, I don't think it's really hurt you as much. So definitely the case. I think high yield credit, leverage loans, those areas of the market are also falling into that category. And that's just here to stay, right? I mean, I don't think we're going to see a withdrawal of that liquidity anytime soon, though our economists do think in the second half of this year, you could start discussing things like Fed taper. So I think that is sort of a latent risk out there, but it's not a risk for today, to your point.
Yeah.
And today, you just have to respect the liquidity in the system.